Valuing a fixed-rate bond. Debt instruments are an important part of the capital market. In this post, we are going to provide an example of pricing a fixed-rate bond. A fixed-rate bond is a long-term debt paper that carries a predetermined interest rate. The interest rate is known as coupon rate and interest is payable at specified dates before bond maturity. Due to the fixed coupon, the market value of a fixed-rate bond is susceptible to fluctuations in interest rates, and therefore has a significant amount of interest rate risk. That being said, the fixed-rate bond, although a conservative investment, is highly susceptible to a loss in value due to inflation. The fixed-rate bond's long maturity schedule and predetermined coupon rate offers an investor a solidified return, while leaving the individual exposed to a rise in the consumer price index and overall decrease in their purchasing power. The coupon rate attached to the fixed-rate bond is payable at specified dates before the bond reaches maturity. The coupon rate and the fixed payments are delivered periodically to the investor at a percentage rate of the bond's face value. Due to a fixed-rate bond's lengthy maturity date, these payments are typically small and, as stated before, are not tied into interest rates. We are going to price a hypothetical bond as at October 31, 2018. We first build a zero coupon curve. A picture on our website shows the market rates as at the valuation date. We utilize the deposit rates, leftmost column, to construct the zero curve up to 12-month maturity. We then use this zero curve to price the following hypothetical fixed-rate bond. Currency, USD. Maturity, 1 year. Payment frequency, semi-annual. Coupon rate, 3%. We use Python to build a bond pricer. A picture on our website shows the result returned by the Python program. The price is $99.94, per $100 notional. Go to our website to download the Python program.